It's official. The long foreshadowed recession is coming. What does this mean for Tesla stock, your portfolios, and our markets? Tesla stock did not have a great day today. Is this red going to continue, or is this time to buy the dip?
This August jobs report, Rick Santelli's got it. Rick.
Yes, the jobs report for the month of August, non-farm payrolls up a slightly better 187,000. That marks 1, 2, 3 under 200,000. However, the last 2 months are seeing a revision of 3 digits, minus 110,000, and we know that there has been benchmark revisions. If we look at the manufacturing payrolls, they were rather strong for a sector that's supposedly in recession, up 16,000. The unemployment rate jumped to 3.8%. 3.8%. In order to find a higher, well, you go to February 22, we were at 3.8. January of 22, 4.0. That's where we're comping on that. And you can see yields falling, stocks liking that. If we look at the hours worked, and this is key, up 0.2, up 0.2. This is very significant. If you look at 0.2, it is the lowest level since we were at 0. That was February of 22. So that shows some improvement if you're looking for wages, which due to strikes and other issues seemingly are one of the pushing channels of inflation. If you look at year over year, 4.3, that's versus 4.4 the last 2 months. 4.3 is the recent low. To find anything lower than 4.3, you have to go all the way back to June of 21. Average hours worked, 34.4. That's a little more than expected, but it shouldn't really be a surprise. And finally, labor force participation rate. Now, this is really interesting. It was 62.6 pre-COVID. That was March of 2020. And we've had a lot of months, 1, 2, 3, 4, 5 months at 62.6. 62.8 is stellar, and that is the highest level since pre-COVID when it was 63.3, and that was February of 2020. So we could see a marked improvement there. And the underemployment rate, I like to monitor this, like U6 is what it's called, versus U3, which is the normal unemployment rate we pay attention to. But the similarities are striking. It moved from 6.7 all the way up to 7.1%. That's the highest level since February of 22. That comp has come out several times. We see that yields have moved down at 406 and 10s. We are now down 18 for the week, 18 basis points for the week. And 2-year, last Friday had one of its high cycle closes. The first time it closed above its March 507, it closed at 508. So at 477, it's down about 30 basis points on the week. I think that's a good place to leave it. I want to bring up one point, though. Quits that was in the JOLTS report this week was also at pre-COVID levels. When you put that together with the drop in JOLTS in today's report, it really does start to paint a picture.
Listen, CNBC's been doing a great job of covering this. We've seen Cameron McNair report that 56% of borrowers are going to be choosing between groceries and paying back their student loans. 70% of college students with debt saving, who are coming out now are afraid for their careers. And so you have this double whammy of two groups really being hit hard. You have millennials who are in their 40s with their own kids going back to school. You have recent graduates. This is going to be a disaster for retail in the fourth quarter.
The unemployment rate came in this morning at 3.8%. You were expecting 3.5%. This is the highest unemployment rate that we have seen within the last year, and you have to go back to mid-2021 to be this high on the unemployment rate. But back in 2021, the government was incentivizing people to actually stay home. So this data is really a non-relevant data point. If you look past the whole COVID era, government incentivizing people to stay home, really from this line to this line, you are at the highest unemployment rate that you have seen since 2019. More specifically, you are at the highest unemployment rate that you have seen since the beginning of 2019. This is a big problem. When the unemployment rate starts to rise, it usually happens pretty quickly if you are going into an actual recession. The personal savings rate back in March of 2023, so just a couple of months ago, as well as April of 2023, was around 4.6%. Now it's at 3.5%. Just in the course of a couple of months, the savings rate is starting to basically plummet again. This means that people are saving like zero money. And this is going to get worse after the student loans start to kick in on October 1st. Some people are not going to pay their payments for a year because they don't have to. And I would recommend you guys, if you have student loans, don't make a payment for a year. It's not going to affect your credit score. Save as much money as possible. If we do go into recession, that's going to put you in the best possible place to be in. I also advise you guys to look into the SAVE program. If you make less than $15 an hour, you're not going to have to pay a payment for your student loan. But let's face the facts. A lot of people are not going to go through that hassle. And a lot of people are going to start making their payments. And that's a total drag on the economy of about $15 billion. This, again, is not great. But just beyond the unemployment rate and the non-farm payrolls and the ISM data we're going to talk about later in this video, look at the delinquency rate on credit card loans. This is from all commercial banks. Do you see this chart? This should be the most, I guess, frightening thing for the markets right now, and nobody is talking about it. The delinquency rate just hit 2.77%. You have not had a delinquency rate this high on credit cards since Q3 of 2012. We're talking 11 years has the delinquency rate not been this high. So people, some people, 2.77% of credit card holders do not have enough money to pay their credit card bills. These things, once they start, are like a snowball effect. Take a look back here in 2005. I mean, you were still higher than where we are today, but once your delinquency rates start to rise, they don't stop. They keep going higher. I shall point out that we have a 2.77% credit card delinquency rate. At the same time, the unemployment rate is at almost an all-time low, or at least it was just a couple of months ago. So imagine where this goes if people start to actually lose their jobs in bigger numbers. Now, I don't want to come off as the doom and gloom guy. I hope everything is fine. But the odds are we're not heading into a soft landing here. The non-farm payroll report that we got this morning showed the U.S. economy added 187,000 jobs. Now, the last month's revision was around 20,000, and we have seen revisions downward to all of the non-farm payroll reports that we have gotten within the last year. Every time they come in high and they get revised down lower. So it makes it look a lot better than maybe what it actually is. But the markets were expecting around 170,000 job ads. So once these revisions really come, I mean, you missed on your jobs report. The U6 unemployment rate in the United States, which also includes people who want to work but have given up searching and those working part-time because they cannot find full-time employment, rose to 7.1% in August of 2023, the highest since May of 2022, from 6.7% in the previous month. And here you can see this chart. And let's go ahead and put this into an easier way to kind of look at this in a column chart. You have not been this high since, again, 2019. Of course, if you factor out this period of time from 2020 to 2022, where the government basically incentivized you to stay home. But there are potential positive implications for stocks such as Tesla and other names that revolve around consumer credit. As long as a recession was not super deep and you did not see the unemployment rate go over 5% or so, just throwing out numbers, as long as it didn't rise too much. Better way to put it. Well, stocks that revolve around consumer credit, because 90% of new vehicles that are purchased on credit. Well, when interest rates come down during a recession, this could actually be positive for some of those companies because it allows that consumer that maybe cannot afford an 8% to 10% auto loan today, it allows those consumers to maybe get a 5 or 6% interest rate during a recession, something that allows more individuals to go ahead and buy that new vehicle or finance that new product. The odds of a pause from the Fed, so no more rate hikes, is now sitting at 92%. So we're not going to get any more rate hikes because the Fed has done too much and they are already pushing the economy into a recession. I think that's pretty clear, and this data really supports the Fed does not need to raise rates again. Unless inflation were to magically rise, in which that does not look very likely. Tesla has cut prices on FSD by $3,000 in the US and $3,500 in Canada. This could actually be a good move to get more people into full self-driving, but that comes with a caveat. The stock does not like that because that hurts margins, at least in the shorter term. Tesla has also dropped the price of the Model S and the Model X, and now they qualify for the US tax credit. This is okay. I'm not concerned about this as a long-term investor, but Tesla stock today did not like it. But Tesla actually did raise prices on the Model 3. Prices are up about 12% to $36,000. So when you net all of these things out, these price cuts on the Model S and X not going to affect Tesla's margins. It actually could improve Tesla's margins because Tesla doesn't sell a lot of Model S or X's, but they do sell quite a few Model 3s. So this could actually have a positive effect. I do think it's important to remember September is seasonally not a great month for the markets. And if we get more of these recession fears, the markets themselves could fall and Tesla stock could fall alongside the markets. That, I think, would be a really good buying opportunity. I don't expect an 08, 09 kind of recession here. That's not what I'm expecting. The day the credit bubble burst, probably 5 to 10 years from now, maybe longer, that's gonna be a really bad one. But I don't think this time is when the debt bubble burst. So with that being said, you got to think about this quite logically. The consumer has been strangled by interest rates. So once rates do come down, a lot of people are going to start taking on bigger credit line products, like a car, like a house. There's a lot of people sitting on the sidelines waiting to see what happens with rates. As long as they keep their jobs and we don't go through a deep recession, well, Tesla will be just fine. And credit companies in general, or companies that revolve around consumer credit, will do okay. They'll be fine. But Tesla specifically has massive brand loyalty. Just a flat out unique brand. Tesla just launched the refreshed Model 3 overnight in China. Hopefully it comes to the US pretty soon. Tesla is also launching the Cybertruck in 2023, the end of this year, if not really start mass production in 2024. Those are all very positive things that are either happening now or coming over the near-term horizon. We also know that there is a massive push to EVs. There is the $7,500 government tax credit that actually becomes applicable to an off your invoice in 2024. Actually starts on January 1st, 2024. So if you get a tax return, it's actually an incentive to go ahead and buy yourself a Tesla or another qualifying EV. We know this trend is intact. This is something you want to be a part of. I think if we do get some downside and we can get Tesla closer to 220 or 200, just depending how the markets react, obviously, nothing's a guarantee. The stock could rally in the 300s before it goes to 200. That's a possibility. And I'm not trying to make an actual prediction here. But any lower you can buy Tesla stock than where it is today makes a lot of sense to me. Keep in mind, Wall Street's estimates for Tesla is 27% delivery growth next year and 29% EPS growth. Even with all of the investments Tesla is making, you're probably going to see better than 29% EPS growth. 27% delivery growth, on the other hand, is pricing in a recession. So even if we get a shallow recession, that's already priced in for Tesla stock. Tesla has never seen 27% delivery rates, ever, in their history. So it would be the slowest growth in Tesla's history. This would not be great, or at least its publicly traded history. Back in 2010, Tesla went public. And during 2009, Tesla's deliveries grew over 600%. I mean, the history of Tesla is pretty good, actually, during recessions. During, obviously, when Tesla almost went bankrupt in the beginning of 08. 09 and 010 were definitely a lot better for Tesla. So when I think about this logically, the markets, they can act irrationally. That's clear. So if they give you a discount on Tesla stock or other names that you want to buy, you better take it. And usually the markets are so forward-looking, if it's not a deep recession, usually by the time you go into a recession, markets have already bottomed. Unless it's going to be a deep recession. Then, on the other hand, that's not the case. And let me know down below in the comment section. Do you think this is going to be a deep recession, a shallow recession, a long one, or a short one? I would love to hear your opinions. Hit the like button and subscribe to the channel if you made it to the end of this video and you are hearing my voice. Check out the links down below in the description of this video as well. You will find a link for Webull. Sign up and get 12 free stocks. You deposit a single dollar. It's basically free money if you have not done it. You might as well go ahead and do it. Start yourself a little side portfolio over there. Maybe it's your trading portfolio. Maybe it's another long-term portfolio. Maybe you sell your free stocks and buy yourself half a share of Tesla or a share of Tesla. Not a bad idea as well. You will also find a link for the trading community. I highly advise you guys to join that as well. Not a financial recommendation, but if you guys are active traders and you want to come hedge out your portfolios, if this recession does actually materialize, well, you could profit from that downside. Take your profits, put it back into Tesla stock at much lower prices. That's ultimately, hopefully, what comes over the next couple of months. You want to be prepared for any downside. So that is it. My name is Michael Tyler. Thank you for watching, and I will see you in the next one.